any possible breakthroughs or pitfalls on trade, all of those big questions remain to be answered. Back over to you.
All right, thanks, Dom. Dom, too. So how do you take advantage of a volatile market? Professor Coe is over at the Plasma with his best strategy. Hey, Mike.
So we're going to talk about using an iron condor, which is a four-legged trade. So we're going to be a little bit careful about how we describe it so that we understand it. The first thing I would say is when you use an iron condor, if you're selling one, so you're selling a put spread, you're selling a call spread, the first thing is you're expecting that the market is in some way going to be range-bound. The second thing you're looking for are circumstances where options premiums are elevated. And right now we're going to be looking at IWM, and what we are seeing is that the premiums are slightly higher than they were, say, in September of last year. So this is a way to look forward at slightly elevated options premiums. And this is also a trade where you're putting time on your side, because the idea here is that you're trying to collect a bit of decay. So taking a look at IWM, what we can see is that certainly over the course of the last couple of months, we've sort of been channeling in this area right here. We're going to try to make a bet that this is going to continue. And specifically, the trade I was taking a look at was the October 162, 163, 171, 174 iron conduit. That seems like a mouthful, but very simply what we're doing is we're selling the 163, 162 put spread, collecting $2.10 when we sell the 163 put, paying $1.90 to cover the downside on the 162s, and then also selling the 171, 174 call spread, collecting $1.90 when we sell the 171 calls, paying $90 to cover that upside. So net-net, with all of this, we're collecting $1.20. The important point here that I would make is you'll notice that the strikes here that I've chosen are only $1 apart here, $3 apart there. And why would I do that? One of the principal reasons is that if it does fall below 163, because I've collected more than the distance between these two strikes, I actually cannot lose money to the downside no matter how far down IW goes. However, up here, once it gets above that strike that I'm short by more than the amount I took in on this trade, $1.20, then I will see losses, but I'm capping those potential losses up at 174. So one could say that this is a trade where we're betting on a range-bound market, but also I'm betting that maybe there's a little bit more likelihood that we could see the market trend a little bit lower rather than substantially higher.
Dan, what do you think of my strategy?
Really interesting trade because he really matches up with some technical stuff that I'll let him speak to. But for the last almost 3 months, this ETF has been trading between 165 and 170, and Mike has picked the strikes, like he said, skewed a little bit to the downside, giving himself a little bit more room for that. But he's playing for the next 2 months that we have more of the same, and this is a good way to collect some premium.
And it would make sense because we know, and this is independent charts, we know that everyone is waiting for a couple of things, most notably what might go on in terms of what's reported by people who are investigating certain things, as well as the election. So that we're in a seasonal week period, August, September, and October, and the market, especially the small cap, having been up 10% year-to-date versus the large cap, it's now consolidated underperforming, having been outperforming all year. So you get equilibrium after a strong advance, or so different, after a big move, you rest and consolidate. We're only 2 months into it, you can consolidate for another month or two.
Yeah, if you're taking a look, if your platform allows you to see what the implied volatility is and also historical volatility, what we can see is that if you go back to September, October 2017, IWM, the Russell 2000, was seeing volatility of about 14 to 15%. Right now, the options market is implying somewhere between 16 and 17%. And so essentially that difference is the value that you're essentially expecting to get, that risk premium that you, as someone who's selling insurance, expect to pay between now and expiration.
And just there is this, obviously specific to the small cap index, it's almost a double weighting in financials relative to the S&P. And that's part of what's going on here is rates have stalled. This index is stalled, so it's quiescent in response to what's going on outside it.
Yeah, and I would just say as far as selling premium in kind of a low vol market, Mike has done this in a way where the width between the spreads is the max potential loss, which on a percentage basis is very low. This is a high probability trade of making a little money at the very least. So to me, I think this really makes sense. And for all those people who've been trying to buy calls, playing for an IWM breakout for the last few months, you've lost your money. So Mike's trade may be the way to do it in the near term.
Yeah, and next week's a big week for trade, and that could definitely have an impact on the direction of IWM.
Well, that's right. I mean, it's certainly one of the things we have to think about, and this is something everybody at home can also think about. If you have a view that's slightly different than mine, I see a little bit more downside potential risk out of these potential catalysts. You can structure your strikes accordingly and try to insulate yourself against a sharp move in one direction or the other.
All right. Up next, Walmart surging up.